don't be too anxious to jump back in or feel like you're going to miss the bottom. Because, I remember the bottom in 2010, and we had about a 12-year or 13-year run up. So if you would have missed 2010 by a year or two, you still would have done really, really well.
Today on the show, the pleasure of welcoming back the legend and the OG of syndication, Mr. Brian Burke. Now, Brian, for those people who don't know who he is the president and CEO of Prax Capital Incorporated, which is a vertically integrated real estate investment company, which he founded way back in 2001. I'm really pumped to have him back on the show, but enough of me. Let's get him out here. G'day, Brian. Welcome back to the show. How you doing, mate?
G'day, Reed. Hey, I guess I got to get you a copy of that book for your book wall behind you right there.
I know.
I see it's missing.
I know. Yeah, no, yes. So we just had Chris Voss on. I've got to get Gino Wickman. We definitely need you on back here. I'm going to get Dan Sullivan for Who Not How. But yeah, please send me a copy. I'd love to see it. But mate, how you been? We're just talking in the green room. For those listeners who don't know, you should go back and listen to Brian's episode number 77, which was 2017 when you were first on this show, which is crazy to think how long the show's been going for. And even at that time, it was 77 episodes, so which is still well over a year. So, mate, bring us up to speed about what you've been doing in the last 6.5 years.
Gosh, that makes you one of the OGs in podcasting, I think.
Yeah, well, my downloads won't reflect that, but yes.
Well, I remember having a good time when we did that, and I was kind of reflecting back on that earlier and thinking, wow, it's hard to believe we've actually been friends that long, and time really flies. It's funny because people oftentimes buy multifamily buildings using 3-year bridge debt, thinking like 3 years is a long time. I got plenty of time before I have to worry about that loan maturity. And here we are talking about having been on a podcast together 6.5 years ago. And it seems like it was maybe a year and a half ago. So time flies. It goes by so quickly that, that's just kind of an interesting parallel to kind of what's going on in the markets these days with a lot of maturing loans out there.
Give the listeners just a bit of a snapshot of what was happening maybe in 2017 in the portfolio then, and what it looks like today. Because I know personally what's happened, but maybe give just the listeners how it's evolved for you as well.
Yeah, quite a difference. If you go back and listen to that episode and then re-listen to this one in sequence, you'll see it's quite a bit different. Back in 2017, we were building our portfolio. I'd been investing in single families for a long time, multis for a long time, but was really in the process of building up, a multi-thousand unit portfolio. We did that. And then in 2021 and 2022, started to see what was happening in the market and decided that it was time for us to pivot and do the exact opposite and start selling all those assets. And we have. So imagine since you and I were last on a podcast together, I've probably bought 2,000 or 3,000 multifamily units and sold 3,000 multifamily units in that period of time, in that 6.5 years.
I think you've got two deals left now, right now?
I have 5 left, which is about 900 units, which is a big drop from 4,000 where we were peaked in 2021.
You mentioned earlier, which brings hallmarks of probably our conversation back in 2017. But even back then, people were saying the end is near, the end is near, the end is near, and short-term debt's coming due. I do remember vividly people talking about, 2013 was the great days, and 2016, 17, there's going to come a lot of maturities, and it didn't come. But now, sitting here with the hindsight of what we're looking back on, can you sort of point to anything that you mentioned that in 2021, 22, you started noticing things that were changing? What weren't you noticing in 2017, even though people were sort of still ringing that alarm bell, like the sky's falling, but now it didn't, but now it is. And you obviously made that pivot back in 21 and 22.
Yeah, I think in, call it 17, people, or 14, 15, 16, 17, during those years, people were saying that, the market was peaking out, the maturities were going to be a problem, that, eventually asset values were going to fall. And a lot of the reasons they were making those comments was because cap rates were compressing and they were getting uncomfortably small for people. And someone that might have been used to a 5% cap rate is looking at a 4% cap and thinking this is just getting ridiculous. during a lot of that time, some people just really didn't know how to properly value multifamily assets and really wouldn't know a deal if it came and slapped them in the face, frankly. And so, they were kind of thinking the opposite, like, things were about to go south. But what was really going on was the market was very, very much in an upward trend. And as a result of that, we didn't have loan maturities creating an issue because people could sell almost at the snap of a finger. They could refinance without any trouble because their values were going up so rapidly that those maturities worked themselves out and never became a problem. Well, that's much different today when values have actually fallen. Certainly, they haven't gone up, and interest rates are higher. And that means that debt service coverage ratios are going to be more compressed, and therefore these properties don't qualify for takeout financing. So this time around, those maturities are going to be a problem. Last time the maturities were there, they just weren't an issue.
How much do you think is it been, we talk about a time, and I personally think it's a little bit to do with it, but 2012, the Jobs Act came out, and the word syndication really started to take form. And you had a lot of people jumping in the pool. And you also had a lot of big institutions starting to view these alternative assets as good places to park money, right? And so you're getting bigger groups coming in. There's a lot more people bidding for it, which then drives cap rates down. Does that have any effect in the story at all over since 2012? I'm just sort of throwing it out there, seeing if you have any thoughts on that. But it all sort of is the perfect storm leading to where we are today, which is obviously a massive drop in valuations, which we'll get onto in a minute.
I think that it wasn't so much is that real estate became very popular amongst investors because the returns were really sharp and because rent growth was taking off. And investors tend to flock to where they think they're going to get the best return. And I don't know that the Jobs Act really was the catalyst to that. I think that was maybe the passenger, not the driver, that certainly the Jobs Act might have opened up the ability for sponsors to advertise to accredited investors. But for the most part, we didn't really use the provisions of the Jobs Act when we were raising capital. We were still sticking with 506B offerings mostly. We didn't advertise in large part because I'm terrible at marketing and advertising. So I didn't really see that as making that big of a difference. Instead, what I saw was runaway rent growth, low interest rates, climbing asset values, all coming together to produce really healthy returns in alternatives, and the stock market being at what some perceived was a high, or certainly getting frothy, and then people were looking for other places to put money that were non-correlated to the quote unquote retail markets. And they sought out investments in alternatives in droves. And you couple that with tons and tons of would-be syndicators that came onto the scene and were raising money from all sorts of people who maybe should never have been investing in the space to begin with. And it kind of created a bit of a frenzy. And I think when you look at the profile of some of the ownership that's currently out there in trouble, you start to see that, where there's a lot of groups that lacked experience, that got investors that lacked experience, that bought at the very peak of the market and are now seeing themselves in a world of trouble. Case in point, there was a 2,000 unit foreclosure down in Houston last year that was kind of met that profile. And I think we'll see others in the near future. And I think that's part of what's causing the reversal.
Let's talk about the 2021 and 22, what you saw that made you want to start pulling out of the market, because I think that's an interesting angle to come at. What were you sort of tracking that was like, this is a time to get the hell out?
I was tracking what other people were doing. I was tracking human psychology. I was tracking how we were getting outbid when we were looking to acquire. And for example, we put an offer on a property and we get outbid by millions of dollars by buyers who are putting up seven-figure non-refundable earnest money deposits that are non-refundable as of the signing of the contract. Before they even get to go step foot on the asset, they're committing seven figures to saying they're going to close. When you see that kind of stuff going on, you just see a general euphoria in the market. And that kind of unjustified euphoria coupled with massive runaway rent growth, extraordinarily compressed cap rates, ultra low interest rates, all those things started to point to me that we were in this phase of the market where kind of more inexperienced gung-ho buyers were really starting to take over. And kind of like, I don't know if you remember the dot-com stock bubble back in 2000. And it's like back then, before 2000, you used to hear a lot about professional stock traders and career stock traders. But then all of a sudden, it was like everybody was a stock trader, right? It's like, I don't care what you knew or you were buying stocks. And then look what happened. Right after that, it came to a massive collapse. And this was kind of the same thing that we saw coming, was like, all right, if people really want to pay those kinds of prices and put down those kind of deposits, let's just see what happens if we put up one of our assets for sale. So we did. And we did a very short marketing period. In that marketing period, we got at least a dozen offers, if not 24 offers, that went way over what we expected that property would ever sell for, with massive amounts of money, non-refundable early in the contract period. And we were like, well, if people want to do that, then they can have it. So let's put up everything else too. So systematically, over the course of about 18 months, one property after another, we started putting them on the market and getting similar results. And then we just started trading off market. It's like we would tell brokers, 3 or 4 brokers, hey, we got this deal. We'd sell it off market if you bring us an offer, and brokers were bringing us offers, and we were getting similar results without even marketing at all. We're getting dozens of offers on properties way over what we expected. And far be it from me to stop someone who wants to pay a very rich price for a piece of real estate.
I completely agree, and it makes sense when you see the market shifting the way it is, and you were sitting on a bunch of good properties. Why not liquidate? That's the game that we're in, right? You amass all the portfolio, and then when the timing's right, get out. Hindsight, you're looking back, put COVID to one side. Do you think, with all the other stuff that we've spoken about already on the show, do you think there was always going to be a correction? Now, COVID's exacerbated, inflation has exacerbated what we're now starting to see in the commercial space, which we'll get to. But if that wasn't there, do you think we still would be seeing these 4 caps and 7 figures and all that sort of stuff? Or is there always going to just be a correction back the other way?
Well, I think if COVID hadn't happened, we wouldn't have had that initial jump that kind of sparked where we're sitting right now. So it's kind of like, if we could rewind the clock back to 2019, COVID or no COVID, if they wouldn't have responded to COVID in the way that it was responded to, we would have had a situation where, in my view, rent growth would have been, moderate. Interest rates would have stayed moderate. Maybe they would have gone up a little from where they were, maybe not. I think cap rates would have stayed reasonable, in the 4s and 5s, given where interest rates and rent growth were at the time. That wasn't outrageous. And that could have continued for a long time, because the interesting part about where we're sitting in this market today is that the underlying fundamentals of this market are actually quite sound. Housing is in short supply. There's an ongoing housing shortage that may never get corrected, with as challenging as it is to get projects approved, and with the cost of materials where they are. And, not to mention the supply chains and financing and everything else. The fundamentals for housing are quite good. So this wasn't a problem of, the fundamentals fell out from under us and that caused rent growth to tank. Instead, what it was is you had this COVID-related stimulus that was created by the government, where, if you look at like the M2 money supply and how really it was like something like 80% of all dollars in existence were created in the last 3 or 4 years. They created all this money and they handed it out like candy, and people started spending it. What do you think they're going to do, right? So that started driving rent growth, because people had their pockets lined by essentially free money. That was driving spending growth, which caused a rise in all kinds of prices, which created inflation. That outsized rent growth is what caused cap rates at the very end to just capitulate and start going down into the 3s. And then all the spending just got out of control. Inflation got out of control. Rent growth got out of control. The government had to basically stick a screwdriver through the spoke of the bike tire to get it to stop spinning by jacking up interest rates. And then that is what caused everything to grind to a halt. And so right now, there's no rent growth because it was all pushed forward into 2020 and 2021. So that, of course, there's no rent growth now. You can't have 20% rent growth forever every year. And then interest rates kind of killed you on the borrowing and cost of capital side. That's the issue we're facing right now.
Right, and also cap rates are, the valuations have gone down, right? So which is where we're finding, back to what you were talking earlier about these maturities, are going to be a problem because you've had an increase in interest rates, quite sharp increase, from 0%. I remember SOFR being close to zero in early 2022 and being close to 4.5 by the end. It's a big jump, and valuations obviously come down. And now, but you got lenders who may be upside down. And I think I'd love to hear your opinion on, are we going to see a 2008-esque type of correction in the commercial multi world, or you think you're going to see a bit more workouts happen with these lenders and savvy investors who want to sort of ride it out, so to speak, until the market chills out a little bit?
The whole thing about valuation is in some form or fashion a function of market sentiment. Whether people like real estate or not like it, and they usually like it or not like it because they're either making money or not making money. Market sentiment is measured by cap rate. And so when market sentiment goes south, cap rates go up. When cap rates go up, prices go down. Now, the cap rate is a function of rent growth and cost of capital. So when rent growth is high and cost of capital is low, cap rates can be low and market sentiment would be high. And now we have the reverse of all of those things, right? The cost of capital is high, rent growth is low, that trends market sentiment down, which drives cap rates up, which means values fall. Very simple kind of supply and demand type of equation. So the falling value is a result of all of that stuff. It's not like a 2008 style crash, because '08 was more of a fundamental collapse in real estate where people were losing their jobs. They were losing incomes. I wouldn't say a glut of housing, but certainly there was enough housing to accommodate the absorption that we had in the markets that were getting any absorption at all. But people were running out of money. I mean, I had an apartment complex in 2009 where I used to joke half the units were empty and the other half weren't paying, because that was the situation people were in. And now we're not seeing that situation. I mean, well, we kind of did, because during COVID, people weren't paying because nobody could evict anyone, thanks to the government's response. But it wasn't because they couldn't pay. I mean, now you literally have, people that can pay. So that's going to support the market to a degree. Now, we've already seen, in my opinion, 20% price reductions off of 2021 pricing. But maybe that brings us back down to 2019 pricing, So if you've got a long-term view, you've done okay. If you bought in 21, 22, you're probably not so happy.
I wanted to quickly touch on that, what you just said about your '09 property, because some of my properties we're seeing with the new supply, particularly in Phoenix, and I know you're invested in Phoenix, we're seeing, and I saw it in the summer, come to an overnight, had to drop rents $200 literally overnight. The first 6 months, you can look back at our ROIs on our turns and our renovations, and we're doing great. And all of a sudden, something happened in the summer, and I am now seeing a delinquency rise. And this is not just in Phoenix; it's all throughout the Sun Belt. We've got stuff in Texas, we've got stuff in the Carolinas, and I feel like it smells. And I wasn't around investing in 2008, but we've got blue collar tenants who are sort of tapping out in terms of rent, the types of rents they can pay. And when they're paying on time, we've had a glut of evictions in the last 12 months across multiple markets. It just smells and feels recessionary, even though I don't have the grey hair to say that I've been through an '08 recession. But something feels not right out there, and it feels like we're the canary in the coal mine in these workforce housing properties to say, well, they're a little great. The GDP's up and the economy's apparently really, really great, but the average worker's not paying their rent on time. They can't afford groceries. They can't afford to keep gas in the car. Something else seems to be going on more than what the headlines maybe say how well we're all doing here in this economy. Do you have any comments or thoughts on that?
Yeah, I can't disagree with you because those are the kind of warning signals you don't want to ignore and then start bulking up on stuff thinking that it's not really true, right? It's better to just see those warning signs and wait. And that's why I haven't bought anything in 2 years. And, I don't know when I will buy another property. It might be a year, it might be 6 months, it might be 2 years, because I want to see certain signs that we're actually on a path to recovery. And I don't think we're there yet. There's still risk that's out there. I think like early on when all this stuff started happening, rents were going up, but wages were going up, and rents at first were kind of the only thing that was going up, right? So landlords had a little bit of pricing power and we could push rents and we did. I mean, there was 20% rent growth in some markets. Phoenix was like 30 one year. It was crazy. Then all of a sudden, everything else started going up, right? The price of bacon doubles, gas is up, 40, 50%, and food is up. And like everything that people buy on a day-to-day basis started getting more expensive, which was putting stress on people's budgets. And now all of a sudden, the landlords weren't the only game in town competing for those extra dollars that people had in their pockets as a result of wage growth. Now everybody's got a hand in their pocket, and people eventually reach a breaking point where it's like, I can't keep doing this anymore. Something's got to give. And so my feeling on kind of the rent performance as far as people paying, it's kind of like, it's not that they don't have the money to pay their rent. It's just that there's so much stress on their wallet to pay everything in total that it's making it more difficult to pay their rent, right? If all that other stuff wasn't happening, they probably would be fine on paying their rent.
Which is also affecting rent growth because people aren't then, climbing over each other to try and rent that one bedroom, which is also another interesting fact. In COVID, and it's probably got to a little bit to do with household formations, and I don't have the data in front of me, but more money in the economy or more money in circulation means that the kid that was renting with the parents could probably move out and household formations could expand. You don't have to live with loved ones or you don't have to live with a roommate. It feels like it's maybe going back the other way now with people trying to look at, because I know that we've had more, just trying to attract people to get tours across multiple markets has been tough. It's been really a slow down effect. And so, again, I don't have the data to say that it's household formations reforming, but it feels that way. And if you look at, we look at what happened in 2020, if you had a little bit more money in your pocket, you're probably going to go rent that one bedroom than renting the two bedroom with your mate or with your mum or your dad. So I don't know if you're seeing that at all, but that was one of the sort of the tidbits I'm sort of trying to hang my hat on, at least, because a lot of people are pointing to new deliveries, and I understand new deliveries are, particularly in the Sun Belt, some places are really overbuilt, like Phoenix and Austins. But I don't know if my $1,000 renter for a studio is going to go and try get the Class A, for $1,700, even if they had 8 weeks free. I don't get that argument, and I don't know if you have any thoughts or comments on that.
Yeah, I think it's just because there's less of that movement, right? So 2 or 3 years ago, there was a lot of population shifting happening. People leaving California for Phoenix, people leaving New York for Florida, people leaving both New York and California for Texas. Right. All that was happening at a very rapid pace, which was putting intense competition on rents. And also those people, when they were making that move to these lower cost areas, they were bringing their higher paid job with them, which was different than what happened in previous population shifts. People would move to a new area and get a new job there, and they'd be making what everybody makes there. Well, now all of a sudden they're making California pay and living in Texas or Arizona, and it was pushing those rents up, and people could afford it. And that was in itself creating household formation just from importing new households, right? Not to mention just people that were splitting out and, leaving from their parents, and that kind of stuff was all happening. Well, now all that stuff is slowing down somewhat because a lot of that movement's happened. Now there's a little bit of a push to back to the office. So people are like, well, can I really leave the area and keep my job? Maybe I can't. Maybe I need to stick around in the Silicon Valley, wherever else I am. And so therefore there isn't as much competition for those available units. And still, while housing remains in short supply, it's not like you have 10 people bidding on every unit like you used to have. So I think we as landlords got spoiled during that, pandemic era where it's like, hey, we got to rent. We just did a turn. If that thing's not rented by noon, what's wrong? And now it's like, well, it might take a week or it might take
Yeah.
2 weeks. And that's why you can't have rent growth, because you can't just say, well, we're going to push the rent up $300 and we're going to get it because everybody wants this unit. A lot of those people are gone. And now you got to compete against other properties, new deliveries, the property next door. All that stuff is all factored in. And, the rent growth already happened. It's not here anymore. I just read an article today. Rent growth year over year is still negative for like the 8th or 9th month in a row. It's still negative. And that's in part why that's happening.
Let's shift now, talk about coming to 2024. What are you seeing? Do you think the Fed's going to start to cut and have reason to cut? Probably is the bigger question. And do you think there's going to be a time where you're going to get back in the pool yourself and start buying assets again?
I really would hope that the Fed would cut, and I would hope that, bond traders would follow suit. I don't have a ton of confidence because I don't feel like they're really paying attention. I mean, they're still talking about runaway inflation, and, they started to soften their stance here in, the last week or 2 weeks or so. We were recording this in early January 2024. So we're starting to see a little bit more rhetoric. Although, now there's some rhetoric about, well, they might actually increase them at the first meeting and then start to decrease them. And it's like, it's just so unpredictable. And I just feel like they're using an outdated model on how they decide this kind of stuff. I mean, if they were in the real world, they would probably see that they've done a lot of damage already. And to mitigate further damage, they should probably consider reversing course sooner rather than later. So that's what I would like to see. I don't have a high degree of confidence we're going to see it, which is part of the reason why I'm still sitting on the sideline. I want to see rates come down, mostly short-term rates. I mean, think about this. I mean, part of the issue, the 10 years that, I don't know, where is it, 4.5, whatever it is. But like SOFR is at like 5 and something, 5.3 or somewhere in there. It's like short-term rates are higher than long-term rates. And that's a problem for me. And until I see that turn around, I can't gain a lot of confidence that we're really out of the woods and on a path to, where we're going to start to see a hockey stick. We may still have a little further to fall, and that'll take time, and time value of money is a real thing. I'd rather wait.
Yep. No, well, look, the Treasury has come down significantly since November. I think it was upwards of 5. It's reduced over 100 basis points in the last sort of 2.5 months. SOFR still remains high, but that's probably more tied to the Fed rate. And I think we'd all like to see that short-term rate and the long-term become uninverted. But, we don't have a crystal ball. I don't think you're headed to NMHC. I know we are, but I know last year everyone was heading to NMHC thinking, let's go, let's do some deals, but I think it was more like that picture of the dog with the tie in the room with the fire. Like, everything's fine. But I think we're still a little bit in that fire room, because back to my point earlier, I think there's still going to be a lot of people with the new valuations and having those maturities really come and whack them over the back of the head, unless you can do workouts with your lender and stuff like that. Any final thoughts for investors coming into 2024, getting started before we wrap up the show?
Well, I think we don't have to buy at the bottom, right? I mean, you want to buy a trend. And right now, the trend is either down or level. And neither of those are really all that investable. So I'm more in the camp of, if you want to buy a trend, you want to buy an upward trend. It's not here yet. So don't be too anxious to jump back in or feel like you're going to miss the bottom. Because, I remember the bottom in 2010, and we had about a 12-year or 13-year run up. So if you would have missed 2010 by a year or two, you still would have done really, really well. So don't feel like, oh, I've got to buy right now because it's the bottom tomorrow and next week it's going to be too high. Real estate doesn't move that fast when it's switching from down or level to up. It does move that fast when it's switching from up or level to down. It goes down at the flip of a switch, but to go back up takes time. You'll start to see the signals. You'll recognize that it's beginning to happen, and then you can go out and start taking a run at deals. Right now, I'm not seeing any of those signals yet, and I can wait until I do.
And the signals to you, again, is just reducing the short-term rate, all those sort of stuff, having the Fed ease monetary policy and all that sort of stuff.
I think that's part of it. I think cost of capital is part of it. I think rent growth and demand for units is part of it. I think population migration trends are part of it. I think investor sentiment is part of it. And I also think, the old Warren Buffett adage of, be greedy when others are fearful is part of it. We haven't seen people fearful. Right now, buyers are fearful, but sellers haven't been fearful. Sellers have been like, hey, I'm getting my NOI. I'm okay. I got years left on my loan, blah, blah, blah. Well, pretty soon it's going to be like, oh, my value is down. I'm running out of cash. The loan is maturing. I have no refi. What am I going to do? And when you start to get more sellers like that, that's when you can start to feel that we're getting to a bottom. And I haven't really seen that yet. So I'm watching and waiting.
Yeah, well, I know you and I are a mastermind. I'd love to keeping a monitor on that as we come into 2024, because I think it's going to, my personal 2 cents is we had 2023 of nothing happening and people kicking the can. I think 2024 is the can's going to start to need to be opened and let let the worms out. So, see what happens. But at the end of every show, mate, we'd love to dive in the quick top 5 investing tips, which is a quick lightning round. You ready to dive into it?
Sure, let's do it.
Mate, what's the daily habit you practice to keep on track towards your goals?
My best daily habit is to study what's going on out there in the world. Study the news, what's happening, economic news, demographic news, multifamily news, real estate news. I really spend a lot of time each morning reading about what's happening so that I can make strategic decisions and hopefully correct ones. And that's, bad decisions will throw all your goals off track. So I try to make good decisions based on all that information.
Awesome. Question number 2 is, who's been the most influential person in your career to date?
There's this guy, Reed Goossens. If you don't follow him, you have to follow him. He's like the podcast OG. He's been around forever.
No, who is it? Seriously, we haven't even got into your story. You've been around since the late 80s. I was looking back at the notes from our 2017 interview.
1989 was my first real estate investment. And the funny thing is, I was like the Lone Ranger. I never had like a mentor. I never had like somebody I followed or got to know. Because when I first started this business, there wasn't even really the internet. There wasn't social media. There was none of that. So I kind of got used to just doing it on my own. I didn't really have like, a guru or a person that I really followed. So that's a really, really good question. And I probably need to come up with someone so that maybe I can, have my next round of success be even better than the last one. I got to find somebody to follow.
No, that's all good. That's all good. Question number 3 is, in your business, what's the most influential tool? And the tool could be a physical tool like a journal or a phone, or it could be a piece of software that you just can't run your business without. What is it?
Well, in part, it's the software that I wrote for myself. Early on in my career, I recognized that I had a way of thinking about my approach to real estate that was very specific. And the only way I was going to get tools that would help me operate in that specific way were to create them myself, because I know what they are, what my needs are. So I always like to say, like, nobody knows what you need better than you do. Mm-hmm. And so if you don't have what you need, make it. And so I did, and we use that stuff every single day. And thank God I did that. And I thank God I did it a long time ago, so I don't feel like doing it again. That was horrible. I spent thousands of hours, and it was thousands of hours I wasn't buying real estate. So that's really difficult to determine how you split your time up between developing your tools and using your tools to really accomplish your objective.
Right. Well, I'm sure we can do a whole episode on just how you came up with that tool, which I'm sure you don't want to share, but it's good to have that ability to be able to go create something and do what you're saying. You're the only one who knows what you need in the business, and so you've got to go out and sometimes create it.
Maybe now you can just have Chat GPT create it for you.
That's right.
Someday, right?
Last question, my friend, is where can people reach you to continue the conversation that will be in your sphere? Where do they go?
They can go to our website, praxcap.com. It's praxcap.com, or follow me on Instagram at Investor Brian Burke.
Well, mate, I want to thank you again so much for coming back on the show. It's been 6.5 years. You're definitely not going to be that long between drinks, I can tell you that. I want to get you back on at the end of this year to see if any of this stuff we've spoken about on today's show has come to fruition. But yeah, really, really interested to see how the year plays out. I think there's going to be hopefully there's going to be some changes, and hopefully we can all get back in the pool. But I'm just looking forward to seeing it play out and see what happens. But again, thank you so much for jumping on the show. Enjoy the rest of your week, and we'll catch up soon.
Yeah, thanks for having me here. It's been great.
Well, there you have another cracking episode, jam-packed with some incredible advice from Brian. Remember, check him out at praxiscap.com or check him out on Investor. Brian Burke on all the social medias, LinkedIn, and all that sort of stuff. I want to thank you all for taking some time out of your day to continue to tune in, to continue to grow your financial IQ, because that's what we're all about here on this show. And the easiest way to give back is to give it a 5-star review on iTunes. So remember, we're going to do this all again next week. So be bold, be brave, and go give life a crack.